What's up? Welcome to your Self-Helpless snack, where we give you a little taste of the Self-Helpless podcast with a mini episode. If you want to dive deeper into this topic, you can find the full episode linked in this episode's description.
So the analogy that I constantly use is like, think about the stock market literally like a flea market, right? It's just a market where people are selling stuff and people are buying stuff. So companies are there selling little pieces of their company, and you're there to buy pieces of their company. So people are buying and selling back and forth. So I tell people, you can buy a little trinket at a flea market, take it home, and be like, holy cow, this is like an antique that's worth thousands of dollars. Look at all this money that I made. Fantastic. That could be like you buying an Apple, a share of Apple 10 years ago, and it now blowing up to what it is, right? Fantastic. But it can also go the other route where you see something at the flea market and you're like, ooh, I think this is valuable, and they don't know it. So I'm going to offer them $100, take it home. You get it appraised and they're like, yeah, this is a total knockoff. It's worth like a penny. Like, you just lost $100. That same thing can happen with a company, right? You think it's going to be really valuable. You think it's going to be the next Apple, and it turns out it's completely useless and it goes bankrupt. So the stock market is all about that. So instead of me betting on which companies I think are going to be the Apples or like the ones that, don't do so well, I just buy everything, right? And that's where the index fund comes in. So I'm betting on the entire US economy instead of trying to handpick which ones I think are going to be the best ones, because most people can't do that, right? Even the pros are really, really bad at picking stocks, like terrible. And yet they keep doing it because, greed really drives a lot of the systems that are in place. So if everybody just bought index funds, who knows what that would look like? But it's only like maybe 10 to 15% of people who invest actually buy index funds, right? So the stock market is just like a market, is what I tell people. And there's going to be good markets and bad markets. You just have to be used to like both environments. I don't do like fad or trendy investments. Is there risk in investing? Absolutely, even with index funds. But it's a much more calculated risk that you can reduce that risk a lot more with index funds than if you were to do individual stock picking. Yeah. So I'll take those odds. There's nothing in life that comes risk free. Even a job. You take a job, there's going to be risk at that job. Like you can lose it, you get fired, you could hate it. There's risk in everything.
Yeah, definitely. If somebody is like really overwhelmed by the amount of debt they have, how can they pay off their debt but also build wealth at the same time? Or do you recommend one first and then the other? What's your perspective on that?
I love this because apparently my opinion is like controversial in the personal finance space, because I'm all about paying off debt while investing, because many people, for instance, have student loans that are going to take them a long time to pay off, right? So imagine telling somebody who is going to have student loans that's going to take them 10 to 15 years to pay off, and being like, you don't have access to investing until you've paid those things off. That's 10 years out of the market. That's a lot of time, right? And that's probably somebody in their 20s and 30s, the best years for them to be investing. So I think it's almost unconscionable to tell somebody don't invest while you're paying off debt. I understand with credit cards, right? Then it's like a little bit different because now we're talking about a much higher interest rate. But even with credit cards, if you're being offered a match at work, right? If you're being offered what's called a 401k, which is an investment account through your job, and your employer is offering to match the amount of money that you put in there, I would say get that match, even if you are paying off credit cards, because that's literally free money, right? Yeah. Do not ever leave free money on the table. And I like using the term free money because it perks people up. They're like, what? But also it's not free money because it's actually part of your compensation plan. Like, trust me when I tell you that when your employer offered you your salary, they took into account, okay, if this person signs up for the 401k, this is how much more money we're going to have to be paying them. They take that into account. So that's part of your compensation. Don't leave it behind.
Thank you for tuning in to Self-Helpless. You can find our brand new merch, Patreon community, and other fun goodies at selfhelplesspodcast.com. We'd be thrilled if you left an Apple Podcast review, shared this episode with a friend, or post about it on Instagram and tag us at Self-Helpless Podcast so we could repost you and say hi. As an independently produced show, we sincerely appreciate your support. Thanks, everybody.